Welcome to Brick by Brick. Join me, Lauren Winnett, as I share my personal journey of building a thriving real estate and hard money lending business from the ground up. Along the way, we'll explore the strategies, challenges, and breakthroughs that come with growing wealth. Whether you're a seasoned investor or aspiring entrepreneur, or simply curious about the world of private lending and real estate, this podcast is packed with actionable insights, real-world stories, and mindset tips to help you build your own path to success brick by brick. Welcome to another episode of Brick by Brick. Today we have a very interesting episode with my friend KC. We are going to be talking all about tax strategy for you as an entrepreneur, you as a business owner, and you as somebody that just wants to pay less taxes to the government to keep that money to create longer generational wealth. So KC moved from a CFO space into tax strategy space. He currently is sitting in Beverly Hills, I believe, California.
Yeah,
other side of the country. And we are going to have a great conversation. So KC, thanks for spending the time with me today.
Yeah, no problem. Looking forward to digging into it and sharing some good nuggets.
Yeah. And before I get too far, so his company is Together CFO, and we will have links to all of his contact information and website at the end, which I will touch on then. But KC, can you tell us a little bit about how you went from, being a CFO, because that's basically where you started at, and moved into the tax strategist space, which a lot of people that I know talk about wanting to work on that or having someone that does it. But I think you're the first actual tax strategist I've ever talked to that I haven't paid.
Yeah, so it's a weird and crazy story, and it was totally unintentional. Just to give you some context on my backstory, born and raised in England. Let's start there. People are probably wondering about the accent. And then worked for a big corporate company straight from university. So the company was called Flowserve. It's a big engineering company, a global $4 billion business. So huge, right? And paid my dues, worked my way up through the ranks in the finance department. Started by making cups of tea and coffee for people and worked my way up. So after, I think maybe a year or so, got my first promotion. After 4 years, was at a good point on the European side. And I got a switch from running the European companies and the finance department to North America. And that's pretty much how I ended up in LA, because the division that I was part of was based in Los Angeles. So it worked out fantastic going from England to LA. Definitely good weather here. So that was great. But quickly realized that corporate America wasn't for me. But I was tied to this company. Long story short, I had to wait to get my green card before I could start my first company and go all in. So that was a big transition, going from a high-paid executive corporate guy, and I'd been with the company 8 years at that point. I'd had multiple relocations and international move. So I was very much a company guy at that time. So to give that up to then back myself, and all I knew was finance and accounting. So it made sense at that point to go be a fractional CFO and help businesses the same way I was working with the big corporation. What I didn't know was sales or marketing or any of that stuff. So that was a really steep learning curve for me, because as you can imagine, a finance guy is not the best salesperson in the room or the market. I didn't know any of this stuff. So I was learning it as I went. Thankfully, we had a really, really great home run very early on. So with one of our clients, we took him from $5 million a year to $120 million a year. And that then created a huge tax problem. The way we did that was nothing genius. It was just, we bought the next vertical along. He was in the medical space, and the next vertical had like astronomical margins, whereas he had good margins at the $5 million rate, but it was just stupidly high. The healthcare system, if you understand it here, you can definitely see where there's huge margins to be made there. So long story short, he goes from making 5 mil to 120, and he's like, I'm going to have a huge tax problem. I'm like, yeah, you definitely are, but you've just made 120 million, so no one's feeling sorry for you. And he's like, you've got to fix it. And I'm panicking at this point, because I'm like, well, I don't know anything about American taxes. I'm English. I've just been a W-2 employee, and now I'm my own businessman. I don't really know anything. I know about strategy and scaling and numbers. I do not know about taxes, but he had more belief in me than I had in myself at that point, and he's kind of forced me into it. And he's like, well, just go do some research, figure out what some big people are doing, family offices are doing, and let's see if we can recreate something. So sets me off on this research task, and lo and behold, there's one entity type that all of these family offices and elite billionaires have, and that is a private non-operating foundation. So it's a 501c3, so it's under a tax-exempt status, but it's a subset under a subset. And when I started digging into this, I was like blown away. I'm like, this can't be right. This is too good to be true. Like, how can you do all of this within this structure? And why doesn't everybody know about this? And the bottom line is, as you dig into it and you keep peeling back layers of the onion, you've got the standard things that people should be doing. If you're a W-2, there's not very many things you can do. You're in the system, you're stuck. If you're a business owner, you're highly incentivized to take as many deductions as possible. And then there's loopholes that are always changing and evolving. You've got to be careful on that. But at a structure level, CPAs or lawyers are not advising their clients on using non-profits because they do not know enough about them to advise them. So you're only good as the team around you that either does know it or doesn't know it, but 99% of the time, they're going to know what they know. Like if you go to your CPA, you could test this very easily. You could ask your CPA, hey, how many 990 PFs do you file? That's the tax return type for a private foundation. Or just ask them, how many private foundation tax returns do you do a year? And if that was any more than 5, I'll buy you a steak dinner, because the CPAs just don't know it. They are highly incentivized to get your filing done as quickly as possible and not really save you money, because whether they save you $10 or $10 million, they're getting paid the same amount. So their incentive isn't to work for you, although people think it is, or they have a long-lasting relationship. And so, that's fine, but just be very clear on the fact that their incentives are to get as many tax returns done as possible, because that's how they get paid. Nothing right or nothing wrong about that, but that's just the facts of it. And they don't know the non-profit world, which actually worked out really well for us, because now, 10 years on, a lot of our referrals come from CPAs, because we don't compete with them on their day-to-day business, but we add another level of tax savings that they're not aware of. So
yeah, it makes a lot of sense.
It was a structure.
It makes a lot of sense because, even just a general CPA, just think real estate for a second. Normal CPA, you're going to have to find the right one that's going to know how to deal with just real estate. And there's going to be more of those than somebody that's as specialized as what you're talking about. And so there's levels to everything. So how did you stumble across this, 501c3? What was the story of finding out about that? And then how did you implement that for this guy that went from 5 million to 120?
Yeah, so it was a bit of luck. Flowserve, the company I used to work for, has a huge treasury department. As you can imagine, it's a $4 billion company. And they are headquartered in Irving, which is just outside Dallas, Texas. So there's a lot of old oil money in and around that area. So I reached out to some of my friends and my network that had been around the block a while and more seasoned than me. And I was like, hey, do you know anyone? Can you do any introductions? And thankfully, a couple of them knew some old oil money families and a couple of family offices. So they all put me in touch together. I went out there, did a lot of golfing, did a lot of steak dinners and schmoozing. And these guys were pretty cool, like very Texas twangy cowboy hats, exactly the stereotype that I would imagine from watching Dallas when I was younger. It was really nice people, right? And one by one, as I was just trying to look for nuggets, the one thing that they all had in common was that they all had foundations. And some of them had multiple foundations. So this is where I was like a little confused. I'm like, hey, why do you have 2? Why do you have 3? Like, what's going on? And they're like, they're not all the same. Now, they would give me little breadcrumbs like that, but they wouldn't spell out the full plan. So then you've got to go do your own research, read. And thankfully, a lot of this information is available on the IRS website. They have a lot of publications, are very, very boring and dry to read, but it is all there. And it guides you step by step, pretty much. So we then figured out it was two main subtypes. Within the 501c3 world, the two subtypes are private and public. So the difference being is that the public nonprofits will solicit donations from anyone. So they can go to a shopping mall, soccer stadium, and they can ask for donations, rattle in the box, and away they go, right? They're perfectly allowed to do that. Whereas a private foundation has completely different rules and regulations and control requirements. So with a private foundation, you are not allowed to solicit donations from anyone. It's usually an individual or a small number of individuals that will regularly donate into the entity. So that's i.e. you or your family, if you've got brothers and sisters or kids or grandparents, whatever, for one family, or you and maybe a couple of friends. It's not going to be at the grocery store outside, hey, can you throw in some change? It's completely different. And then also when you get deeper into it, the requirements on board members and committee members is completely different. You have so much more power and control in a private foundation than you do in a public foundation, because in theory, in a public foundation, you're supposed to have board members, committee members, subcommittee members, so that there's full, clear transparency. You don't need as much red tape in the private foundation as you do in the public.
Got it. So let me just spell this out, see if I understand. So you're in a position where you're going to be taking home a significant amount of income. You want to reduce your tax burden. And so you set up a private nonprofit foundation and you contribute your after tax, well, I get your distributions and whatever your money in there. And then
your
how
AGI,
does that,
gross income.
your AGI, okay. So you contribute a good chunk of it into this foundation. How then does that impact your tax liability, and how is it kept separate from your business so it's not just seen as some sort of pass through?
Yeah, great question. Let's just say you have multiple businesses, so everything rolls into you as an individual. So your AGI, let's call it just $1 million, just as an example, right? And let's say you pay 30% tax rate. So in this scenario, on the $1 million, you're going to pay $300,000 in taxes, right? With me so far? Now, let's use a different scenario where we've got the same $1 million at the top, but you can donate to your own foundation. So with a private foundation, you can donate 30% into the foundation. So your AGI would go from $1 million down to $700,000. So you would now be taxed 30% of 700 rather than 30% of $1 million. So that would be $210,000. So that's a straight cash saving of $90,000 by making that $300,000 donation.
Got it.
Does that make sense?
Yep, makes sense.
Now you can use that $300,000 that you've donated to the foundation, because you still control it, and you can invest that into real estate, into stocks, into businesses, whatever you wish, because that's creating your legacy now. Because now this foundation can grow. Your children can then become board members or future board members, depending on how old they are, and get involved. And this is how you create family legacy, because now, as every year 300,000 will get added in, it's going to start growing quite quickly to a point at which you can start accumulating some big assets and start making some good passive income. And then that passive income is all taxed at a 1.4% tax rate. So it's very, very low. And then on top of that, if you did buy, let's say, real estate and it accumulated in value, and there's no capital gains tax. So you might buy a piece of real estate for $1 million year one with your $300,000 down payment. But then by year 5, it might be worth, let's say, $5 million. And then when you liquidate that, there's zero capital gains tax to pay.
Got it. And that's it. So the money's in there. If you liquidate, the money still has to go back, stay in the foundation, correct? And it just kind of keeps growing that pie. What are the rules around pulling money out of the foundation or adding money in excess of that 30%?
So there's other ways to add more money in. Like I said, there's multiple people that can contribute. And then there's one entity type, which is a complex trust that can actually donate 100% of what it earns into a foundation. So if you didn't want to donate 30%, you wanted to donate 50%, then maybe do some business from a complex trust, and that can feed into the foundation. So 30% is the minimum. 0 is the minimum, but 30% is the maximum AGI directly into a private foundation. If you wanted to increase that, you could use a complex trust to do that. So when you're taking money out, there's a couple of ways in which you can do it. You can take a salary, for one, is the most popular way to take money out if you need it personally. Now, ideally, the money that you're putting in shouldn't be anything you need personally. Like if you need it personally, you're better off just paying the tax and use it personally rather than try and flow it through a tax exempt company just to reduce that taxes. That's not really the purpose of why it's in there. But in circumstances where you need to do that, payroll is the way to do it. There's very strict rules around self-dealing and disqualified people. So as an example, if you've got $1 million of cash in your foundation and you're the one who donated it in, you are classed as a disqualified person. So you can't then write a loan from the foundation to yourself.
Mm-hmm.
But you can write a loan from the foundation to other people as long as it meets the definition of a loan, which is has an interest rate and it has a time, right? So let's use hard money lending as an example of this. The foundation can issue hard money loans because it's passive income for the foundation. And it could issue that loan to your brother or to your sister, but it can't issue it to your mother or father, wife or kids, because that's your direct lineage. So that's where a disqualified person also then spills over to your family lineage, but it doesn't go sideways. It only goes up and down. So parents, kids, and wife, but brothers and sisters are not classed as disqualified unless they've personally donated into the foundation.
That's interesting because when I think about this, I'm thinking family offices in my head, right? I'm aware that a lot of times family offices, when the children of the G1 or maybe even G2 want to start a business or go to college or something, often they're given a loan from the family office at a very small interest rate, basically just to send it out. It has to be a loan, right? So in this strategy, that would be precluded because they would be direct lineage. So you just have to figure out a different way kind of around.
In those scenarios, what we tend to see, and again, I said this earlier, there's multiple foundations, right? So maybe if you have a brother, as an example, then your brother could issue your kid a loan, and that's perfectly fine.
Got it.
So that's one way around it. Another way that we see a lot is insurance policies as well. So a lot of these foundations, they are heavily insured through life insurance because it is a way to meet the 5% requirement. So there's another requirement that you can't just keep accumulating cash in these private foundations without a level of activity. So let's just say year 1, you put 300 in, year 2, you put 300 in, year 3, you put 300 in. So you're at 900,000. You can't have no activity against that, like no expenses, no donations, no nothing. There has to be something in line with the mission and with the purpose. And that can be payroll expenses. It can be travel expenses if you're doing your board meetings in Hawaii or Australia or Singapore or wherever you want. It can be research, right? So if you want to research on your mission, and if you've got 5 different charities that you are considering donating to, maybe you want to go visit all 5 of them to see which one really resonates with you, because You can only tell so much from a phone call or from a website, right? So there's a rule there that says you have to have an activity of 5% of your net assets. So if your net assets were $1 million in cash, then 50,000 a year would then have to have some level of activity, whether that's rent, travel, payroll. You can't just keep stacking cash and having zero activity from it, right?
And does activity include moving it into investment vehicle, like investing in a multifamily or a fund or something? Or is activity meaning outgoing, meaning it has to be
Yeah,
expenses,
expenditure activity, to be clear. Yeah,
expenditure
that's why
activity?
they call it the 5% expenditure rule. That's why. But the just to be clear on that, because people often get misunderstood, is that most people understand that rule that, hey, you have to donate 5% of the asset value every year. You don't. And it clearly states this. It's you can donate or expend through your regular business
Mm,
expenses, right? So people miss that piece. That's either or. It's not exclusively just a donation.
got it. Okay. So far in this conversation, we've been kind of talking about the $100 million, huge type investor, somebody that's making 120 million a year in their business. Does this only work for the really high net worth, someone that's going to put $300,000 $400,000 in a year, or does this work for on a smaller scale, that someone that's maybe making $1 million a year in revenue, from their business, and they've maxed out their 1K contributions and they still have extra income that they want to store off to the side without paying all the tax?
Yeah, what a great question. Quite honestly, the old answer to that is that yes, exclusively it used to be for high net worth individuals, ultra high net worth individuals, family offices. That's all 20, 25 million plus. And then when we saw that there was a huge gap in the market, that there's no one taking this one piece of what we call strategic giving and bringing it down to an entrepreneurial level where most people need it, right? So if you're making multi seven figures in your business and you're paying too much in taxes, too much can be defined as, let's say, $1,000 or more a year in taxes, then that's where this type of structure makes real sense for you. Now, whether
Got it.
that's through a liquidation event on a capital gain, or you're selling a business or an asset, or whether that's just coming from multiple businesses or even one business. But if you're paying over $200,000 a year in taxes, this type of structure is definitely something you should explore, because previously you haven't had access to it. It's only been for the country club elites and the ultra high net worth family offices. And you may have known of it or heard about it, but never had access to a team that can execute it for you without paying a $5 million a year operating cost, right? Because if you have a family office, the average family office costs in and around $5 million a year to operate. So it's kind of the niche that we moved into when we moved away from CFO services into tax strategy. This is why, because I saw, hey, we implemented this strategy for our client, saved him $12 million year one. He was over the moon. And then my alarm bells went ringing. It's like, it's really difficult to explain what CFO services are to people, because it can mean so many different things to so many different people, whether you're a CFO who's doing a raise for a startup, whether you're a CFO who's doing an IPO for a bigger company, whether you're a CFO at an enterprise level company versus a mom and pop. It's all so completely different. We were having trouble really figuring that out, niching down, because again, I don't have a sales and marketing background. I'm a finance background, right? So then to quickly realize that everybody wants to save on taxes. I've never met anybody who doesn't want to save on their taxes, right? Everyone gets worried, oh, is too good to be true? Is it real? Is it legit? Well, the letter comes directly from the IRS giving us an approval for every single entity that we set up. So you don't have to even believe or trust me, but you can trust the IRS, right? Because they're going to give you a determination letter saying that, hey, the Lauren Foundation is now 501c3 tax exempt private foundation. submit this type of tax return every year. Then it's black and white. And now it's the next level of, okay, now I've got the exemption. What do I do? Because I don't want to mess it up. I only get one shot at this. So then we kind of pivoted and we then focused on, one is the entity creation and setup based on the needs of the client. But then two, the ongoing process is to make sure that you are fully compliant at all times because there's so much red tape. And then secondly, bookkeeping and tax filing is all done in accordance to those rules and regulations, which is different to the GAAP rules and regulations that people are using in their LLCs, S Corps, and C Corps. So that's where we work really well with CPAs, with wealth managers, with insurance brokers, and real estate people because we don't step on their toes, and they love it because they get an additional benefit on top of everything else.
A whole bunch of questions there and all that.
Ahead, yeah.
But I'm going to start with the very last one that came to my head was, okay, you're working with, let's say, somebody CPA that's been doing their books for years. Do you get a lot of initial pushback when you bring this concept in? Because by nature, CPAs are conservative people, right? And their big thing is they don't want to be the reason that someone said, oh yeah, we're going to do this. And then their customer gets shafted somehow. And so do you get a lot of pushback on them? And if you do, how do you overcome?
Yeah, massive. So much pushback you wouldn't believe. Ultimately, it's got to come from the need of the client, right? So the way I approach that is, firstly, respect them, regardless of how much the client's been overpaying every single year. The client still has a trusted relationship with that CPA. So you have to show a level of respect, firstly. And I leave my ego at the door every time I get into any conversation with anyone. So it's like, hey, what are you doing? What are we trying to get to? So if we put the common goal here, front and center, can all three of us, because the client has to be in on this call too, can all three of us agree that we're all here for the best interests of Lauren, who's our client, and we want to save him the most amount of money in the best way possible? And the minute they agree to that, it's game over, because I can always circle back to, well, it's really simple. If we disagree on something, we can ask the question, is this in the client's best interests? And the long and short of it is there's apprehension on the side of the CPA because they don't know what they don't know. So there's a really easy fix for that. It's go spend some time, research and read, and then you will know some more stuff, right? But they don't want to do that because they're lazy, they're caught up with their own stuff. Why am I, a random person, giving them extra work to do, right?
Right.
Well, I'm not. I'm saving your client money because that's what my job is. So there's always tension there unless the CPA comes into it with the same frame of mind and doesn't feel threatened. I've got to, my job is to make sure that I do not threaten the CPA that their client is going to leave them and come work with me fully. I make that very clear day one, is that, hey, this is your client, you're doing his tax returns, all we're doing is the bookkeeping and the tax filing for the piece that you don't know in a nice way. And that's it. Now, if the client wants to come and switch to us, again, that's further down the line. I'd never do it right out the bat. But some people get really angry at the CPA and they're like, why don't you know this? Why haven't you told me this? Why is this random guy that I just seen on the internet teaching me more or saving me more than you've done in the last 10 years? So depending on how the client deals with that and their reaction to their CPA, because sometimes their CPA is their brother-in-law, they can't fire him, or their wife will go crazy and it's not worth the hassle. So there's all of these different dynamics with each client. Ultimately, I don't need another tax client, LLC, C Corp. That's not what I specialize in. I stay in my own lane and I master my own lane. So it's like when it comes to strategic nonprofits, that's when you call me. If you just want an LLC, there's a million people that can do that. If you're a real estate LLC, there's millions of people that are miles better than me that doing that. Go hire them. But if you want to wrap it into something strategic where you're getting down to zero capital gains tax and 1.4% on passive income, they can't do that. That's when you give me the call. So know when you want me and when you need me, and know when you don't. And I'm happy either way, because it isn't going to change my life whether you work with me or not. It's going to change your life. So I come into it with that state, with that frame, and ultimately just always trying to come from a lens of education. It's like, I'm going to teach you this. You can go research it and do it yourself. You don't need me. But if you want to fast track and do it quickly, that's where I add value. Then pay me to go quick. But if you don't want to go quick and you're okay going slow or don't want to do it at all, then, that's fair play to you. But I'll share with you what I know, because I live in an abundance mindset. I'm not one of those people that are like, oh, I've got to keep all this knowledge to myself. Can't share it with anyone because someone will go and copy it. This was here long before I got here, and it'll be here long after I've left. So what is the real value that I'm adding is that I've been there, done that, got the experience, and I can do it strategically a lot quicker than you could ever do it yourself.
Yeah, I think that's a great point. I've never heard of this, right? And I'm in this world all the time. And so if it's been around for a while, I haven't heard of it. Not to say that I know everything, but you're offering something that other people aren't able to do. And to the CPA point, I mean, there's probably some of it like they just don't want to look stupid in front of their client, right? And they don't want to lose that client. And so there gets to be that defensiveness. But can I give you an example here from a real estate side of things? And 1031s, very common tax strategy. So let's say that we have a developer or builder that's going to sell a subdivision and is looking at a pretty significant in sale of each of these properties, right? Let's make it simple. It's actually a multifamily unit, and they're going to have one sale, and they're going to have this big piece, and they can choose to do a 1031 and move that into a like for like property, or do this private foundation. How would you talk to them about this, and which strategy would be better for them based on that specific scenario?
Yeah, great one. We get this daily as well, so this is a fun one. So first and foremost, you have to understand what the client's needs are, because not every person doing a 1031 will be in the same situation, right? So it comes down to a few main broader questions. What do you need the money for, right? Because if you do a 1031, we already know there's a lot of requirements, right? There's a time-bound requirement, like-for-like asset. Right now, if anyone's doing a 1031, the likelihood is the cash flow is going to be really tight because the interest rates are a lot higher now than when they probably bought the building. And then if you don't complete in time or with one of the selected properties, you're still going to have a huge tax problem. So there's a lot of risk involved with the 1031s in that regard. But if you are all in on real estate and that's the only thing you're ever going to do in life and you know that, it could still work. All you're effectively doing is buying bigger and bigger pieces of real estate and kicking the tax deferment down the road. And then who knows what the future holds, but if we just look at the general trend of taxation, it isn't going down, is it? So the longer you kick it down the road, likelihood is the bigger that tax bill will eventually be one day if you ever did liquidate. Now, the trick is never liquidate, just borrow against it. And if there's equity there, but again, it's harder to build that equity. So once you understand the client's kind of situation, then you can start advising adequately. Because normally they already know a 1031. They've normally done a couple. They're quite comfortable with that. It's nothing new to them. It's like riding a bike, right? They've done it before. They can do it again. But with the foundation, it's completely different, because now you're going to take that real estate asset and you're going to donate it to a foundation. But effectively, you're donating it from your left hand into your right hand, right? And then for that donation, you're going to get a huge tax deduction, which you can use over the next 5 years. One thing we didn't mention earlier, but if we're getting into the weeds of it, that tax deduction, if you don't use it all in year one, you can roll it over for 5 more future years. So there's a lot of benefit in that as well. So it's a huge piece of real estate and you don't have all of that income to write it off against. That's where the benefit of that comes in. But now let's just say you donated the land, or the multifamily in this case, into the foundation. The foundation then sells it. The foundation can sit on the cash. It can reinvest it in any asset type, whether it's stocks, bonds, real estate, art, crypto, whatever you want, whenever you want. You can hold it for a year, then invest. There's just so much more flexibility. But the downside is also what you got to look at, right? Because that's the upside, is that, hey, the money comes in, no capital gains, amazing. Tax deduction, amazing. I can hold the cash, I can diversify, amazing. But that cash is owned by the foundation. So if you need that money personally, you shouldn't do that. So if you wanted to go, as an example, if you wanted to go buy a personal residence for yourself, but the money's in the foundation, you can't do that, because that's self-dealing. You can't live as a primary residence in an asset owned by the foundation, but you can rent a house to your brother because that's not self-dealing. Does that make sense?
Yeah, no, it does make sense. I mean, it seems like it gives you a lot of opportunity for different options, right? Versus 1031, which is just kind of domino affecting up to bigger properties. But this one gives you the option to do a whole bunch of other things. I want to ask one thing specifically. So with this big, beautiful bill that came out and the 100% bonus depreciation that's part of that, do you as an investor that uses this private foundation, do you get to take advantage of that if your properties are in the foundation, or do you not even need to worry about it because the properties are in the foundation, you're already being taxed at such a low rate?
Yeah, it's tax exempt. So again, back to what we talked about earlier on loopholes. Loopholes are forever changing, right? So when we first saw bonus depreciation, it was at 100%, and then it tiered down for 20%. And now it's only because Trump's back in, he's reinstated all that. So for real estate people, for business people, that is amazing, because now your jet can be bonus depreciated, your helicopter, your yacht, all of these big toys can also be depreciated the same way as a low level person would probably do a car or a truck. The higher up that pay scale you go, you can do the same thing with yachts and jets and helicopters, right? So it works really, really well. But back to what we were saying on loopholes, loopholes are always changing, right? So a couple of years back, we saw a huge change and then a shift in conservation easements, where the government was pushing people to do conservation easements. People took advantage of it, kind of went too far a lot of the time, got audited, and then the whole rules changed and then were backdated and changed. So there's so many audits because people took too much advantage of a loophole.
Mm-hmm.
So the difference with the private foundation and the structure versus a loophole is that the structure is already tax exempt. So you don't need to play around with loophole level tactics, because it's already right off day one, effectively, if you wanted to use that terminology. And a great example of that is property tax. So if a property, some real estate, is paid and has no mortgage on it, you can apply for something called a property tax exemption. And if you get that exemption approved at a city level and then at a state level, you don't have to pay any property tax.
Interesting. That's
But that
interesting.
only applies to foundations, right? So
Right.
again, there's different levels to the game. And then if you're at that level of ultra high net worth, you probably have a lot of real estate that's been in the family for decades that has no mortgage. And now in LA, it's nearly 2% property tax. It's crazy.
Oof.
So it can become a significant amount of money as your estate or as your foundation grows. And then as you keep adding more and more legacy in there and more generations in there, because it's not like a flat line. This is like a hockey stick the way it compounds. If you're adding money in and it's growing tax free, right now in California, people are paying 35-40% tax. Imagine if you weren't. Imagine if it goes down to 1%. How much more money you can compound every single year. And that's just in your lifetime. And then imagine these elite families like the Rothschilds and the Rockefellers that have been doing this for multi-generations, and then they wrap other powerful compounding things like insurance in there. And now you you've put fuel into the fire, and it's just holy smokes. This is a all tax-free environment as well. So there's many different avenues that you can go down, but again, each family is different, each circumstance is different. We've seen families where unfortunately they have 3 kids. One is a great kid, the other 2 not so much, or vice versa. So rather than squandering that family fortune, you can keep it in the foundations or split out foundations. Warren Buffett, prime example. He said he'd never leave his kids any money. He's just donated $3 billion each to each of his kids, $9 billion donation from the Buffett Foundation to each of the kids' foundations. And that's completely tax-free. So the estate planning threshold that just got increased in the new bill to 15 million, 30 million for couples doesn't really apply to billionaires because they're just donating it from their foundations to their kids' foundations. And this is another way, again, different psychology, right? But the principles are the same, is that you got to really get comfortable with ownership versus control. And if you can get comfortable with that principle, that's really what separates the ultra wealthy from the rich. Because they're okay not owning anything, because they don't want to own anything. They want to be a ghost on paper, right? I'm sure you get this a lot with your real estate stuff. You put things into trusts or into LLCs, into Wyoming or Nevada. You just want to be private so no one can search and ding your name, right? But think of that game at a higher level, at $100 billion level, or a couple of $100 million level, right? It's the same thing, but it's on steroids. They don't want anything in their name, so they don't need to be owning it. They need to control it.
Control it.
That's it. So if you have a jet, a yacht, fleet of cars, helicopters, none of them are going to be in your name if you're smart. Zero. But the entity that does own it, you have access and approval to be able to use all of those toys for business purposes, of course. But you get what I mean.
Yeah, I get what you're saying. Yeah, that's really interesting. I think there's like light bulb goes off. And I'm like, all these rich, very rich people have foundations, right? And when you initially hear that, you're like, oh, what a great person. They have a foundation for charity. But you never really hear what their charity is, or even if you do, the charity might be a small portion of that. They're probably doing what you're doing is from a tax saving purpose for a big portion of the rationale.
Yeah, well, that's why they have multiple. So not to take away from any of the people that are actually doing good.
Of course.
We will all be doing good. All of my clients all donate to actual charities and all do good. This isn't good versus evil, right? This is, we want to do it in a strategic way where we can protect assets, save on taxes, create a lasting family legacy, and do some good at the same time. Like, there's always a mission and a purpose in there. And you'll find that most people donate to charity regardless of how much they make. They don't have to be a high net worth person to give their local church or synagogue or mosque some money. It doesn't have to be millions of dollars, right? It's just the intent inside. And then what we see that happens is as that person goes on and kind of has more, they give more. So that tends to be within most good people anyway, I would say. And what we're doing is giving them the tools to be able to do more of that, but then also get these additional benefits, which we've been talking about.
You can give a lot more if you pay a lot less taxes.
And that's 100% true, right? Is if you're saving 30% on your taxes, does it make a difference if you give 5% back to charity? Charity that you love or that's impacted your life. As an example, this started with my grandma. She had a pacemaker in her heart, and it must have extended her life 15 years. So those additional years that I got with her is because of a medical device that she had put in. So I'm forever indebted to the person or the institute that came up with that. So of course, if I've got excess cash, I would try and help them because of the impact that they had on me in my relationship with my grandma. So just, it can be small things like that. It doesn't have to be, hey, I've got to donate $5 million a year. Like, no, it's not a requirement. The only requirement is a 5% expenditure rule, and that's expenditure or donation.
Or donation.
in other entities, so there's other charitable entities like a donor advised fund, there's no requirement to donate at all. So a lot of these billionaires have a donor advised fund, a public charity, a private charity, and they stack all these different entity types together. And then that they kind of make their own mixture, like their own personal IV drip system that suits their family's needs. And that's ultimately what we're doing, but we're taking it from a family office elite level and bringing it down to a multi-7-figure business owner level.
Awesome. So let's say one of my listeners, we're getting up to Q3 tax planning season, and they realize that they're going to have a huge tax liability coming up, when the new year rolls over. How long does it take to get one of these things set up? Do you need to kind of have it set up before you have that problem? Or can you get one set up, say, in December or January of the year and have it retroactively take a hold of the income or the AIG that you had the previous tax year?
Yeah, you'd want to get it up and running as soon as possible in this year. So as an example, you've got until December 31st to get all your documents into the IRS and processed. And hopefully it comes back with no questions and they give you a straight approval. Again, we know with what's happening in the world right now that the IRS is getting a lot less funding. A lot of people are leaving. They're not hiring. So the squash is being put on them by the current administration. So I would only assume that the lead times for getting things out are going to be a lot longer. So whereas it can take as little as 4 to 6 weeks, we've also seen it take 8 months. So we've been doing it a long time, right? So we've seen the ups and downs throughout the years. So I would say if there's something that you're interested in doing, start the conversation now, because even if there's no harm in one having a conversation, but if you want to move forward with it sooner so you can get your approval before year end so that you can make your donations, because you can't make your donations next year because that's then the next tax year. So you got to make the donation this year.
Got it. Makes sense. And do you see that, better question. Are there any other things that you need to do to your business, to how you're paid as an entrepreneur or business owner, or any other structural things need to be adjusted besides just getting the 501?
Well, you look at how much you're taking, right? So if you know that you're going to donate 30% at the end of the year of your AGI, how much do you want to roll up to you personally as a salary versus a distribution? There's always a question, right? Because then you're paying payroll taxes on top of all of that. So I would say crunch the math on that to see how the strategic giving structure fits in with that. And then even if you're a W-2, you can still use a private foundation structure. The same rules apply to AGI. So let's just say we have a lot of doctors and lawyers that are W-2s, high-paid people, but stuck in the system, right? They don't get any deductions like a business owner. But they can do the same thing with the example that we said. They can donate 30% of their salary into their foundation, and that will reduce their taxable AGI. But again, in that example, it would save them $90,000 day one on taxes alone, and then they would still have the $300,000 to invest in the name of the foundation.
Awesome. Anything that we didn't cover that you think's critical, or you get a lot of questions on that you think the listeners need to know?
You've got 3 more hours.
So maybe, I think what you just talked on there of, if you don't know exactly what things, or you want to talk about your distributions versus your W-2s, all that, like that's where that conversation with the CPA, with you and with the customer all fits together, correct?
Yeah, but again, we don't always need the CPA. If the client knows what they want and they're like, yes, I already give, like a lot of the times we'll speak to people and they're like, well, I already give my church 10, 15% anyway, every single year without question. Okay, well, why not just do that through your foundation? Now you can give your foundation more, get a bigger tax deduction, still give your church 10, 15%, whatever you normally do. And they're like, okay, it's a no-brainer at that point, right? So we can just go ahead and create and get all the paperwork done. And then when it comes time, it's just a calculation that we need to do, mainly with the bookkeepers, to see, hey, what do we think that AGI will be? and what is going to be 30% of that, and what is going to be the number that the client feels comfortable with donating if it's going to be more than that. So do we need to then add in additional entities and structures to get higher tax deduction?
Love it. Love it. Okay, so I'll ask you the question I ask everybody at the end of my podcast. If you know exactly what you know now and could go back to yourself when you were 18 or to your kids when they turn 18, what advice would you give to that person?
Personally, have kids sooner, get married and have kids sooner. The blessing. Secondly, the way I kind of looked at my life in decades is in my 20s, I'm figuring stuff out. I'm having a lot of fun. In my 30s, I'm going to optimize, double down on what's working. And then now, as I've just entered my 40s, I'm going to have my family and make stupid amounts of money and be really comfortable. So I'm on track for all of that. So my overall plan, even from when I was younger, is pretty good decade by decade. I think generally speaking, live your life, experience as much as you can. One big regret that I had was I didn't go traveling as much as I would have loved. In Europe, it's very common for people to take a gap year between university and starting working. And I was all set to do that and go backpacking around the world for a year, but I got a job offer. So I took the job offer. I don't regret it, but I always wish I'd spent more time traveling. Now I just travel differently, right? So it's still cool. It's much nicer now than it would have been back then. But I think to have as many experiences as possible, moving to America and kind of seeing the way people live here, I feel there's a huge difference in mindset compared to Europe and the rest of the world, where we're kind of brainwashing people into being corporate drones and worker bees and not focused as much on family and friends and living and enjoying your life. Where in Europe, it's completely different. It's like, hey, we've got this beautiful family or friendship group, or we're going to be doing a lot of things together. And then, yes, we'll get the work done and we'll do work, but family and living comes first and work is second. Here, it's the complete opposite. So I think to reprioritize, thankfully I grew up there, so I could see the difference. But when I speak to my American colleagues and they're like all in on work, and it's like, okay, I can see the American side versus the European side.
Yeah, I feel that, especially the traveling thing. Similar, I got out of college, went right to work, and just this push to, you got to get your life started, you got to get going, because retirement's coming. You have to have yourself set up,
And
and
that's the biggest scam going, right? If you look at Robert Kiyosaki, goes over this like perfectly. He's like, we're all in the rat race, so we're on the hamster wheel and we're running around, and it goes from, again, astronomical amounts of debt for student loans here. College costs 100,000, 300,000. It's mind blowing compared to the rest of the world, where it's like 10% of that, 20% of that. It's crazy. So from day one, you're already at a disadvantage because you're in this huge burden of debt. Then you finish and you start a job, if you're lucky enough to get a job these days, if AI and a robot hasn't taken it. Then, okay, so now you're on the ladder, you're in the corporate world, you meet someone, a significant other, whether it's a guy or a girl, and you get married. Huge expense, wedding ring, wedding, house, kids, school, private school.
daycare.
Like, my goodness, it just keeps going and going and going on top of everything that you have. And you can definitely see why people call it the rat race. And then to end it all, you look at the likes of 1K, a retirement fund, social security. All of this stuff is going to be gone by the time we get that age, let alone our kids. So it's like heavily underfunded. The whole model is like a Ponzi scheme that's totally illegal if you or I were to start business doing that same thing right now. And it's like, what is going on here?
Yeah. I mean, they've priced everything. So you get your 2 or 3% pay increase. Everything goes up about that much or more. And you never can catch up or get ahead unless you're just so dedicated and committed to not spending money, which there are people that do that.
You can't. There's no way to get ahead unless you have family help, because to your point, pay's been going up 2 to 3%, inflation's been going up 7 to 8%, but house prices have been going X. So now the difference between, let's say, our parents when they were working and they were maybe 3 or 4x more, let's say their salary was 50,000, they could buy a house for 150. So it's 3x or 200, right? Now that same house, if you're making 50, is 400,000, 500,000. It's too big a gap. So unless you've got some family help or a rich uncle that's passed away that you didn't know about, there's no way for young kids to get on the property ladder. And it's really, really sad when you look at it.
Yeah, I mean, I think there are ways, but going to college isn't necessarily the best way, right? I mean, the trades pay a really good salary with no college education required. And like, I have 2 college degrees. I have a bachelor's and a master's. I don't use either one of them. You know, I'm in hard money lending. I got agriculture degree and an entomology degree. So you just have to think about college as, is this going to give me a return on my investment? And maybe I need to go do something else. And there's plenty of ways to make a lot of money without having a degree. You just have to be willing to put your nose down, grind, and think about things a little bit differently than what you're programmed to do.
I just paid some 20-year-old kid last week $5,000 to create some AI for one of my companies. And it's like, this kid, he looks like he's straight from college. And it's like, if he's good, if he knows what he's doing, people will hire you. So unless you're needing something specific, like let's say medical engineering, where you need to be at a very high level and approved to be able to build a building or do a back surgery, you definitely need to go through all the protocols for that. But there's so many things that you don't need to do for that, right? So if you wanted to go, like you said, trade is a great one, be electrician, HVAC, never going to go out of business, right? Always going to give you solid income wherever you want to be. Or if you want to be an entrepreneur, which is much more cool and fashionable now, right? You can go specialize in AI, coding, whatever you want. Learn things from free online courses or YouTube or wherever. And you can go make $1 million very, very easily if you just pick the right thing.
Yeah, very easily. Just going to take some time and you're going to have to deal with some stress. I think the biggest thing with entrepreneurship. Yeah, that biggest thing with entrepreneurship is people think, oh, I'm going to go make $1 million. Yeah, you will. It's going to take you a decade. So just don't quit on year 2. So
just don't quit. Yeah, that's the key. I think, with the younger generations, as we see, they're so different to us, our generations, as we were to our parents and grandparents. It's that just the world is moving so fast, right? And you go from a dot-com bubble to going to the moon with something that was powerful as a calculator to now these quantum computers that can decrypt anything. And it's like, it's just mind-blowing where the future's taking us.
Okay, KC, this has been a great conversation. If anybody wants to reach out and get a hold of you, where's the best place to do so?
Yeah, togethercfo.com. You can use that social on any platform as well. Feel free to check our website out, set up a free complimentary call. We're happy to show you exactly how much you've been overpaying on your taxes. In maybe 15, 20 minutes, we can get to that. And then exactly what to do, which you should already know if you've watched this podcast, but more importantly, how to do it for your specific situation.
Awesome. So you think you're going to have a $200K or more tax bill, reach out to KC. He can certainly help you out. All that information will be in the show notes. KC, this has been a real pleasure. I got a lot out of this conversation. I hope our audience does too. So thank you for being on this. And for all the audience, thank you for your time. And we look forward to seeing you on Brick by Brick next week.
Thanks for having me. Take care.
Thanks for tuning in to Brick by Brick Wealth Building Conversations. If you enjoyed today's episode, don't forget to subscribe and leave a review. It helps more people find the show. For more tips, resources, and updates on my journey, follow me on Invest with Lauren. Let's keep building wealth, one brick at a time. See you next week.